Welcome to the deep dive. We take topics that can seem pretty complex, look at a whole load of sources, and we'll pull out the really important stuff for you. Today, we're getting into something foundational in finance, something that often feels a bit intimidating maybe, bonds. Ever wondered how big companies or, governments fund huge projects, or how you could even be part of that? Well, this deep dive is really about getting you up to speed quickly and confidently.
Exactly. And that's our mission here, really, to kind of demystify bonds. We want to unpack their core features, figure out how they actually function day to day, why their prices move around so much, and maybe even touch on some surprising aspects you might not know about. The goal is those aha moments, without drowning in jargon.
Okay, so let's start with the absolute basics.
Yeah.
A core idea. When you buy a bond, you're not buying a piece of the company, like with stock. No ownership here. Instead, think yourself more like a bank. You're a creditor. You're lending your money to whoever issued the bond. Could be a corporation, could be a city, could even be the federal government
Hmm.
for a set amount of time.
Right. And in exchange for that loan, the issuer promises two main things. They'll pay you regular interest payments, and then, crucially, they'll give you back your original loan amount when the bond matures or reaches its end date.
So it's a formal contract, essentially.
Precisely. It's a contract between the issuer, the debtor, and you, the investor. The issuer promises what's called debt service. That's the sum of all the interest payments plus that final repayment of the loan value at maturity. And a really key point, if the issuer misses any of those payments, well, that's a default,
Yeah.
officially.
And for the company or government issuing the bond, this method of raising money, it's often called leverage financing, right?
That's the term. Yes, they're borrowing against their net worth. If a company, say, has more debt than equity on its books, we'd call it a leveraged issuer.
Okay, so to really get this, we need to break down the parts of a bond, the anatomy, if you will.
Let's do it. First up, par value. You'll also hear principal or face value. This is simply the amount the issuer promises to pay you back when the bond matures. Usually it's $1,000 or multiples of that. So you buy a
hmm
$1,000 par bond, you expect $1,000 back at the end.
And that's key. You get that $1,000 back regardless of what you paid for the bond initially, assuming you hold it all the way to maturity.
Exactly. That maturity repayment is fixed at par. Though it's worth mentioning, some U.S. Treasury securities can have smaller par values, like $100.
Okay, par value is the repayment amount. What about the interest? That's the coupon rate.
That's it. The coupon rate is the fixed annual interest rate. Usually fixed, anyway. It's set when the bond is first issued and typically doesn't change. For a lot of people, this steady income stream is why they buy bonds in the first place. You calculate the annual interest based on that $1,000 par value. So a 6% corporate bond pays $60 a year.
And payments are usually spread out, right?
Hmm.
Not one lump sum.
Correct. Most bonds pay interest semi-annually. So that $60 per year on a 6% bond, that typically comes as two $30 payments.
Got it. Now, why do some bonds pay, say, 6% while others only pay 3%? Why the difference in coupon rates?
Ah, good question. It often boils down to risk and time. Generally, bonds with longer maturities, maybe 20 or 30 years, tend to offer higher coupons. Why? Because your money is locked up for longer. There's more uncertainty, more risk over that longer period, so investors demand a higher return.
So more time equals more risk equals potentially higher reward via the coupon.
Pretty much. Shorter-term bonds are often seen as safer, so investors might accept lower rates. But it's not just about time. The issuer's credit risk is a huge factor, too. If a company is seen as financially shaky, a higher credit risk, they'll have to offer a higher yield, a higher coupon to convince people to lend them money. They're essentially paying extra for the risk investors are taking.
You mentioned coupon rates are usually fixed, so there are exceptions.
Yes, definitely. While most are fixed, some bonds have what are called adjustable variable or floating rate coupons. These rates aren't set in stone. They change periodically, often tied to some market benchmark like the prime rate or another index. So they move up or down with general market conditions, a different beast than fixed rate bonds.
Interesting. I've also come across terms like long coupon and short coupon related to the first interest payment. What's that about?
Right, that can seem a bit fiddly. So bonds usually aim to pay interest on set dates, like the 1st or 15th of certain months. But when a bond is first issued, the interest might start accruing from a specific dated date that doesn't perfectly line up with the first standard payment date. To get everything synchronized onto that regular schedule, the very first interest payment might cover a period longer than 6 months. that's a long coupon, or shorter than 6 months, a short coupon. It's just an administrative thing, really, to get the timing right going forward.
Okay, makes sense. Now, sticking with interest,
Hmm.
what if I sell my bond between those semi-annual payment dates? Do I lose out on the interest that's built up?
No, you don't. And that's where accrued interest comes in. It's quite important. The seller is entitled to the interest earned from the last payment date right up to, but not including, the day the trade settles. So the buyer actually pays the seller that accrued interest as part of the transaction price. It ensures the seller gets paid for the time they held the bond. Just a small note. The calculation method is slightly different. Corporate and muni bonds use a sort of simplified 30-day, month, 360-day year. U.S. government notes and bonds use the actual number of days. Minor detail, but good to know.
Okay, and then there are those bonds that don't pay any regular interest? Zero coupon bonds, how do they work?
Zero coupon bonds, yeah. They do exactly what the name suggests. No periodic interest payments, no coupons. So how do you earn anything? Well, you buy them at a deep discount to their par value. Let's say a $1,000 par value zero coupon bond maturing in 10 years. You might buy it today for, I don't know, $600. Then you just hold it. At maturity, in 10 years, you get the full $1,000 par value back. That difference, the $400 in this case, is your interest earned over the 10 years. It's just paid all at once at the end.
So the return is baked into the price difference.
Exactly. And the longer the maturity of the zero coupon bond, generally the deeper the initial discount you buy it at. They can be quite useful for long-term goals where you know you need a specific amount on a specific date, like college savings or retirement. Set it and forget it almost.
Okay, so we have individual bonds with par values, coupons, maturity dates. When an issuer sells a huge amount, maybe billions of dollars worth, how do they structure the repayment of all that principal?
Good question. Issuers use a couple of main structures. If all the bonds in a single offering mature on the exact same date, say $500 million all due in 2035, that's called a term bond issue. One single maturity date for the whole lot.
Okay, one big payment date. What's the alternative?
The alternative is a serial bond issue. Here, the bonds mature in installments over several years. For example, an issuer might sell $50 million in bonds, but structure it so $10 million matures each year for 5 consecutive years, spreads the repayment out.
I see. And I think I've also heard of variations like level debt service or a balloon maturity.
Right, those are refinements often within serial issues. Level debt service tries to structure the principal and interest payments, so the total amount the issuer pays each year is roughly the same over the life of the bond issue, smooths out their cash flow needs. A balloon maturity is common with serial bonds too. You might have smaller amounts maturing each year, but then a very large portion the balloon comes due in the final year.
So different ways for the issuer to manage paying back the debt.
Exactly,
Yeah.
tailoring the repayment schedule.
All right, so let's shift gears a bit. We buy a bond, maybe at $1,000 par value, but you mentioned prices fluctuate. Why? What makes a bond trade for, say, $950 or $1,050 after it's been issued?
That's a really crucial concept. Bond prices do change in the secondary market after they're issued. They can trade at a discount, meaning below that $1,000 par value, or at a premium above par. And there are two really big drivers behind these price movements.
Okay, what's the first one?
The first, and arguably the most significant for most bonds, is interest rate risk. This is all about the inverse relationship between prevailing market interest rates and the prices of existing bonds. This is fundamental. Think about it. If you own a bond paying a 4% coupon and new bonds are suddenly being issued that pay 5% because market rates have gone up.
My 4% bond doesn't look as attractive anymore.
Exactly. To sell your 4% bond, you'd likely have to lower the price, sell it at a discount to make its overall yield competitive with those new 5% bonds. Conversely, if market rates fall to, say, 3%, your existing 4% bond looks great. It pays more than new bonds, so its price will likely go up. It'll trade at a premium.
So rates up, bond prices down. Rates down, bond prices up. Inverse relationship.
You got it. And a key point here. Long-term bonds are much more sensitive to these interest rate changes than short-term bonds. A small shift in market rates can cause a much bigger price swing in a 30-year bond compared to a 2-year bond. That's interest rate risk in action. The longer the time horizon, the more impactful rate changes are on the price.
Okay, interest rate risk is the big one. What's the second major driver?
The second is credit risk. This is the risk that the issuer might actually default, that they won't be able to make their promised interest payments or repay the principal. If investors start to worry about a company's financial health, the perceived risk of default goes up. What happens then? The price of its existing bonds will likely fall, and if they want to issue new bonds, they'll have to offer a higher yield to compensate investors for that increased risk.
And the opposite is true too. if a company's prospects improve.
Right. If perceptions of creditworthiness get better, their bond prices tend to rise. Stronger credit equals lower risk equals generally higher prices for existing bonds.
So how do investors, gauge that credit risk, especially for companies or cities?
Well, for U.S. government securities, treasury bonds, notes, bills, the credit risk is considered virtually zero. They're backed by the full faith and credit and, crucially, the taxing power of the U.S. government. Safest you can get in terms of default risk.
Okay, treasuries are straightforward. What about corporates and municipals?
That's where credit rating agencies come in. You've probably heard of them. Moody's, Standard & Poor's, S&P, Fitch Investor Service. Their job is to analyze the financial health of issuers and assess the likelihood of default. They then assign a credit rating to the bond issue. These are usually letter grades like AAA, AA, A, BBB, BBB, and so on. S&P uses pluses and minuses like A plus or BBB. Moody's uses numbers like A1, A2. Higher grades mean lower perceived credit risk.
So an investor can look at that rating as a sort of shortcut to understanding the risk.
It's definitely a major input, yes, a key piece of information. But it's worth noting, not every bond issue gets rated. Sometimes smaller municipal issues, for example, might not be rated simply because of the cost or complexity involved. Doesn't automatically mean they're bad, just unrated.
Got it. So prices fluctuate based on interest rates and credit risk. How are these prices actually quoted in the market? If I look up a bond price, what format will I see?
Bond prices are typically quoted as a percentage of their par value. It's pretty intuitive once you see it. A price quote of 100 means the bond is trading at 100% of its par value. So for a standard $1,000 par bond, that's exactly $1,000. We call that trading at par. If the quote is, say, 90, that's 90% of par, meaning the bond costs $900, it's trading at a discount. And if the quote is 110, that's 110% of par, or $1,100, trading at a premium.
Okay, percentage of par. Simple enough. I've also heard prices talked about in points, like the bond is trading up half a point.
Yes, that's very common terminology. Each point is simply 1% of the bond's par value. Since par is usually $1,000, 1 point equals $10. So a bond quoted at 99 points costs $990. A bond at 101 points costs $1,010. It's just shorthand for the percentage quote.
And do they always trade in whole points?
Oh, definitely not. Prices are much more granular than that. Corporate and municipal bonds usually trade in increments of 1/18 of a point, so you might see a price like 93.58. That 58th of a point is $6.25, $10.58. So the bond price is $930 plus $6.25, $2,100. U.S. Treasury notes and bonds trade in even smaller increments, 132nds of a point. So prices can be very precise.
Okay, so points and fractions of points relate directly back to that percentage of par value.
Exactly. It all ties back to the dollar price relative to that $1,000 benchmark.
You mentioned yield a couple of times, referring to return, but you also hinted it's not quite as simple as just the coupon rate.
That's right. Yield is a measure of return, but there are different ways to calculate it, and they tell you slightly different things. We have the nominal yield, which is basically the coupon rate, the current yield, which relates the annual interest to the current market price, and probably the most comprehensive measure, the yield to maturity, or YTM. YTM considers the coupon payments, the price you paid, the par value, and the time until maturity. It's a more complete picture of your total return if you hold the bond to maturity. We'll definitely need to unpack those different yields in a future deep dive. They're crucial for comparing bonds properly.
Looking forward to that.
Yeah.
So bonds have a maturity date. That's when you expect your principal back. But can that change? Can a bond be paid back early?
Yes, it absolutely can. A very common feature, especially in corporate and municipal bonds, is a call provision. A call provision gives the issuer the right, but not the obligation, to redeem the bonds to pay them back before the scheduled maturity date.
Why would an issuer want to do that?
The main reason is falling interest rates. Imagine a company issued bonds years ago paying 7%. Now market rates have dropped, and they could issue new bonds paying only 4%. If their old 7% bonds are callable, they can redeem them early, pay off that expensive debt, and then issue new, cheaper debt at the current 4% rate. It's like refinancing a mortgage to get a better rate. Saves them a lot on interest costs.
Okay, great for the issuer. But for me, the investor holding that 7% bond, that doesn't sound so great. I lose my high-interest investment.
That's the trade-off, exactly. It introduces reinvestment risk for you. You get your principal back early, but now you have to reinvest it likely at lower current market rates. Because of this risk to the investor, callable bonds almost always offer a higher coupon rate, a higher yield than similar non-callable bonds right from the start. That higher yield is essentially compensation for giving the issuer that call option, that flexibility.
Is there any protection for the investor? Can they call it the day after I buy it?
Usually not. Most callable bonds have a period of call protection. This is a specific number of years after the bond is issued, maybe 5 or 10 years, during which the issuer cannot call the bond. Gives the investor some certainty for that initial period. And if the bond is called after that protection period ends, the issuer often has to pay a call premium.
A premium,
Yeah.
meaning more than the par value.
Yes. They might have to pay, say, 102% or 103% of par value if they call the bond in the first year it becomes callable, with the premium perhaps declining over time. So if your $1,000 par bond is callable at 102, you'd receive $1,020 if it's called. It's a little extra compensation for the early redemption. Calls can also be structured differently. Sometimes the issuer has to call the entire issue in whole call, sometimes only a portion through a lottery system, partial call. There are even catastrophe calls if, say, the facility financed by the bonds is destroyed.
Okay, so calls benefit the issuer when rates fall. Is there an equivalent feature that benefits the investor? Can I choose to get my money back early?
Yes, there is. It's called a put provision, or a put feature. This is basically the mirror image of a call. It gives you, the bondholder, the right to sell the bond back to the issuer at par value on certain specified dates before the final maturity.
Ah, so if interest rates have risen significantly since I bought the bond.
Exactly. If rates have gone up, your bond with its lower coupon is probably trading at a discount in the market. But if it has a put provision, you can put it back to the issuer, get your full $1,000 par value back, and then reinvest that money at the new higher market rates. It gives you flexibility when rates move against you.
That sounds like a very valuable feature for an investor.
It definitely is. And because it's so advantageous for the investor, puttable bonds generally offer lower yields, lower coupons compared to similar bonds without a put feature. You're essentially accepting a slightly lower return in exchange for that valuable option to redeem early if rates rise. You pay a bit for the flexibility.
Makes sense. Okay, one more special type I want to ask about. Convertible bonds. These sound like they blend bonds and stocks.
They do, in a way. A convertible bond gives the investor the option to exchange the bond for a predetermined number of shares of the issuing company's common stock. So you start with a bond, receiving interest payments, but you have the potential to convert it into equity later on.
Why would a company issue these?
Often, companies with maybe weaker credit ratings or companies wanting to make their debt offering more attractive will issue convertibles. That conversion feature, the potential stock upside, allows them to offer a lower coupon rate than they'd have to pay on a regular non-convertible bond. So it lowers their interest cost. Plus, if the bonds are converted, the company effectively turns debt on its balance sheet into equity. This is called deleveraging. Mandatory interest payments become potentially voluntary dividends.
Okay, issuer gets cheaper debt and potential deleveraging. What's the draw for the investor?
For you, the investor, it's kind of a have your cake and eat it too scenario, potentially. You get the regular income and relative safety of a bond, the interest payments, the principal repayment promise, that's your downside protection. But you also get exposure to the potential upside of the company's stock. If the stock price takes off, you can convert your bond into shares and participate in that growth.
So, stock potential with a bond safety net underneath.
That's the general appeal, yes. Now, there are some key mechanics, two important terms: conversion price and conversion ratio. The conversion price is the effective stock price at which you can convert your $1,000 par value bond into stock. The conversion ratio tells you how many shares you get for each bond. You calculate it by dividing the par value, $1,000, by the conversion price. So if the conversion price is set at $40 per share,
then $1,000 divided by $40 means I get 25 shares per bond. That's the ratio.
Precisely. Conversion ratio is 25.
Okay, let's make that practical. Imagine I have that widget bond, convertible at $40. The ratio is 25 shares. Let's say the bond itself is currently trading in the market at 85. That's $850. And widget's actual common stock is trading at $35 per share. Should I sell the bond for $850? Or should I convert it into stock and then sell the stock? What's better?
Great scenario. Let's run the numbers. Selling the bond directly gets you $850. Clear enough. Now, conversion. You convert one bond, you get 25 shares, the ratio we calculated. If you immediately sell those 25 shares at the current market price of $35, 25 shares times $35 per share equals $875.
So $875 from converting and selling the stock versus $850 from just selling the bond.
Right. In this specific case, converting yields an extra $25. So converting first is the slightly better financial move for you. You always compare the market value of the bond to the market value of the shares you'd receive upon conversion.
But what if the issuer doesn't want me to wait? Can they make me convert? I've heard of forced conversion.
Yes, that can happen. It's a strategic move by the issuer, leveraging the call feature that most convertible bonds also have. Here's how it works. If the value of the stock you would get by converting is significantly higher than the price the issuer would pay you if they simply called the bond, they might initiate a call. Let's tweak the example. Conversion price, $40, ratio 25 shares. Stock price is now, say, $45. If you convert, 25 shares at $45 is worth $11,125. That's the conversion value. Now, let's say the bond is callable by the issuer, but only at 100/5, meaning they'd pay you $1,050 if they call it.
So $1,125 if I convert, but only $1,050 if I let them call it back for me.
Exactly. By calling the bond, the issuer effectively forces your hand. Faced with the call, your rational choice is to convert the bond into stock, getting $1,125 worth, rather than letting it be called away for less, $1,050. You'd be leaving money on the table otherwise. That's forced conversion.
Clever. One last thing on convertibles. Taxes. What happens when I actually convert? Is that a taxable event?
Good point and important clarification. The act of converting the bond into stock itself is generally not considered a taxable event in the U.S. Instead, your original cost basis in the bond just transfers over to the stock you receive. So if you originally paid, say, $1,200 for that convertible bond, and you convert it into 40 shares of stock, your cost basis for those 40 shares becomes $30 per share, $1,200 divided by 40. A taxable event only happens later when you eventually sell those shares. If you sell them for $35, you'd then have a capital gain of $5 per share. $35 sale price, $30 cost basis. But the conversion itself, usually tax neutral at that moment. Okay, wow. We have really covered a lot of ground today, from the very basics, what a bond is, being a creditor, all the way through how prices move with interest rates and credit risk, and then into these more complex features like calls, puts, and especially those convertible bonds. This really feels like it shortcuts the path to getting a solid handle on these crucial instruments.
I hope so. And understanding these mechanics, these nuances, it's not just academic. It genuinely helps you look at investment opportunities, whether it's individual bonds or bond funds, with a much more critical, much more informed perspective. You start to see the why behind why a bond is priced a certain way, what risks are really involved. It moves you beyond just definitions to actual understanding.
Absolutely. So thinking about all this, especially the convertible bonds and that idea of forced conversion, here's something to ponder. What does it really tell you about how the specific design of a financial instrument, like a bond, can fundamentally shift the power dynamic between the entity raising money and the person providing it? Something to think about. Keep digging, keep learning, and we'll see you on the next deep dive.